Okay, welcome back. Let's pick up where we left off. We were just talking about net income and revenue. And from those two, you divide your revenue into your net income to get your profit margin. And that margin is, well, you saw it in the last one. So from there, we go into just a couple of more. And hang with me on this because if you can take those, maybe what, four that I told you in the first one and just one or two other ones, I think three more, you've got a couple of great numbers to, and the more you use these, the more you're going to get very comfortable with them. But I'm promising you, these basics are going to get you past, in my mind, 50% of the investors out there. Not that it's a competition, but the more you do your homework, the better your buys are going to be, the more money you're going to make. I mean, that is the idea. So let's talk about free cash flow, okay? We talked about revenue, which is everything that you get after paying all of that out, and you've got that nice, pile from every, the sales and everything from the company. Well, you're going to need to invest some of that back into the business, buying equipment, for example. That equipment purchase, those investments that you make back into the business from your revenue, those are called capital expenditures. You're going to hear them called CapEx, okay? People love to use, again, acronyms and abbreviations in this business. So capital expenditures, you think about that, capital. You've got human capital, you've got property, plant, and equipment, and that kind of capital. But taking what you make from the business and reinvesting it in that, let's say, equipment, into your CapEx, your capital expenditures, once you make those investments, what you have left after that, okay? You got your revenue, you invest some of it back into the business, which takes some away. Then what you have left is free cash flow, okay? Free cash flow, not operating cash flow. Forget that. We want free cash flow only because that literally, and we are down to the bottom of the financial statements. Actually, the cash flow statement is the third after the balance sheet. Well, the income statement, the balance sheet, and the cash statement of cash flows, where again, just to simplify, okay? You're taking in this money, you're making a little money over here, you've got your revenue, which is, that's your profit, and you can do your profit margin, and then you invest a little bit back into whatever it is. You're buying a data center, or you need to buy some more, whatever it is. What you have left after that is your free cash flow. And that is a fantastic measurement as well because that tells me, first of all, is a company, do they have positive free cash flow? That's always important to know as well. And but that to me is flexibility. That is flexibility for the company to grow more, to reinvest, to grow, to give you, the investor, back some money, whether it's in a dividend or to buy back their stock. And they can use that free cash flow for that as well. And when they buy their stock back, that literally means, let's say there are only 10 shares out there and you have one of them, and the company has free cash flow and they buy one extra share from the market back. Well, instead of 1 out of 10 shares that you own, now you own 1 out of 9. So stock buybacks are accretive for you, the investor. So that's free cash flow. And then the only two other ones that I really want you to look at, one is the beta, okay? Um, you're going to see Greek letters used in this business, and beta is one of them. Simple. The beta of 1 means that as the market moves, that stock will move with it. So when I say the market, you remember we talk about only the S&P 500 because it represents, 90% of the largest companies out there and all 11 sectors, and it's 500 stocks. It's just the gold standard. So the beta of 1 means that if the S&P, essentially, if the S&P for the day moves up 1%, your stock will move with it in the same, 1%. But if your stock has a beta of 2, the beta is a term for volatility. So the higher the beta, the more volatile the stock can be. Now, that can be good volatility, it can be positive volatility and negative volatility. And so a beta of 1, it moves in step with the market. A beta of 2, being higher volatility, as the market goes up 1%, that stock will go up 2%. But if it falls 1%, your stock falls 2% as well. So just know that beta means volatility. Volatility means it's a little bit riskier. So there's greater risk and greater reward as well. So that's beta. And then the last thing I want you to know is the short percentage of the float of the stock. So the float, meaning that all the stock that is out there basically for public consumption, okay? It's not the full issue, but it's what people can buy and sell. So the short percentage of float. Now, the short percentage is just that. It's the percentage of people that have bet the stock, that have shorted the stock, betting that it's going to go down. Okay. And so short percentage of float. And I just want you to look at the beta and the short percentage of float, because the short percentage of float, to start with, I would recommend and say that, well, it depends what kind of investor you are. But again, if you keep your beta low and you keep that short percentage of the float low as well, you're going to minimize your volatility of the stock. For the short percentage, if it's 2% or low or less, so in other words, of all the stock that's out there in the float, uh, if the number of the percentage of shorts that are into the stock betting it's going to go down are less than 2%, 2% or less, that's fine. Okay, no worries. Let's say it's 5%. Now you're getting a little bit more concerned, because if you've got let's say the stock is going down, well, those shorts are going to pressure it to go down even further. And just remember, they're always going to be a drag on the stock, whether it's going up or going down. So at 5%, I would say that might be a good cap just to start with, as far as where to draw the line. Anything above, let's say 8% or more, again, I would say 5%, but once you get into 8% or 10%, anything above 8, that's untouchable. Um, it's just not, it's a risk. And like we talked about in a previous video, it's first and foremost, you want to preserve your capital. And we can talk about riskier investments later on, but to keep the risk low at first, you want to keep your beta a little bit lower. And again, beta of 2 and below is okay. Same thing with the short. A short of 2 and below is just fine. A short of less than 5, okay. But let's just focus on that for now. With that in mind, I'll tell you right now that some of the most reliable stocks, the companies that are the best in class, are going to have some of the smallest, the lowest short percentage, because the company does so well, because they deliver on on their promises, on the numbers that they forecast. And so the short sellers generally over time are not going to be attracted to that. So things like Apple, things like Microsoft, you're going to, and look these up, look all these great companies up. And while we're at it, let me just add one more thing that And those are all the numbers, okay? That's it for the numbers. So if you can just think about, I think there are 7 of them. If you can just start to go through your stocks and when you're shopping for stock, and you'll get to know those like the back of your hand. And you're going to be such a better investor. And they really do give you a great perspective. Um, so now for just a couple of non-number ideas that I want to throw in. We just talked about the competition. Okay, every sector there are 11 different stock sectors, like energy, like financials, like technology, you know, healthcare. Um, you look within those different sectors and you compare companies within that as far as the competition. And my one thing that has served me well is to always go with the best in class. Okay. So when you are looking at a biotech company, when you're looking at anything and you've found the numbers can reflect that. The management of the company who runs it and the products that they have. For example, you know, the iPhone. I mean, you know, again, you know, yeah, there's competition to it, but let's face it, you know, it is has incredible loyalty behind that brand. And so really Apple is the best in class when it comes to phones, certainly in the United States, 100%. So always look at your risk and always think about keeping your risk down. And I don't want to swing for the fence. I want to hit singles. I want to step up to the plate, and I'm fine with hitting singles and doubles, and I'm not going for the big swing, okay? Because I want to be careful with my money. I don't want to lose my money. And so keeping your beta low, keeping your short percentage low, and investing in the best in class. These are a few things that can really help to minimize that risk and serve you well. And with that in mind, I just wanted to remind you about something we talked about earlier, that over 90%, and I would say over 95% of your time easily is going to be sitting on your hands. Just a reminder, I am not spending I'm spending a tiny fraction of my time actually trading. I am spending almost all of my time researching, analyzing, going through my numbers. Now, with that in mind, I still will research and look into a stock. And when I've made my decision and when I've started into that trade, and as we talked about before, deciding what your full allocation to that stock will be, dividing it up into fours, and each one is a tranche. And after I've made that first tranche investment and I've got the other three, then I like to think about babysitting that stock. And I only do one and maybe two at a time. But I babysit that stock until I have invested almost always the rest of what I have to put into it. But I like to give that my full focus every single day. So that means that every day, and this doesn't take a lot of time because even when you come home from work, you can still do this. Again, pull up your app. For me, that's Yahoo Finance. Scroll all the way to the bottom and it'll have the news feed. Read the news of the stock each day. It'll also have news of the competitors to that stock as well. You know, hey, Verizon is laying off a bunch of people. AT&T is, they're going to be mentioned in a lot of the same articles. And so every day, research the news, okay? Up at the top of the app, you've got the chart of the stock. Just see what it did for the day. Was it up or down? Look at the tape for the day, okay? It swung, it dropped in the beginning of the morning, it came back up, whatever it is. every single day. Just go through. Just type, look at the day, look at the last 5 days. I do the day, the 5 days, the month, the year, and 5 years. You can click right down below. It's got the different, time frames, and that'll give me a picture of the stock today and be like, oh my God, look at it. It dropped way down. Okay, it dropped way down, or I should go this way for you, it dropped way down. But as I pull out to 5 days, 1 month, and then 6 months, let's say, it's been going up like this and it just dropped a little. This was the one day. Okay, that's it. So starting with the 1 day, the 5 day, the month, 6 month, 1 year, 5 year will show you the chart of what it's, and just remind you where it's come from and where it is now. Takes 2 seconds to do that. Also look at the volume of the stock that's traded. Right below it, it's going to have what the average daily volume is. For example, maybe 1 million shares are traded on average each day, which is pretty high, but 1 million shares. And today it traded 1,000,005, okay? So it's above average trading. I like to know, that the lower volume days, not as interesting to start out with. When it's above average volume, was it an up day or a down day? That means there was a flood of buying or selling. So the stock was nice, up 2-3% for the day, and it had double the average volume. That to me is a signal of new buyers coming in, of lots of attention. So usually, or sometimes that will be attached to a positive catalyst that's in the news. So all these things work together. So look at the volume. It'll give you a great feel for it. And then, a few other things. Go to the company website. Just browse around. Look about all of them. Check everything out. And we'll get into a little bit more because I really want to stress at some point how important it is to get to know a feel for the people who are running this company. On that note, on the company website, always listen to the earnings calls. Okay. We talked about earlier, you only need about half an hour and you don't need to be there live, but every 3 months, I'm asking you to dedicate 30 minutes of your time, maybe 60, to listen to the call, at least the first half of the call where the leaders of the company report the numbers and then they start taking questions from analysts, which I don't really care if you listen to that, but listen to the earnings calls. You can find that on the website as well under investor relations. Okay. So that's great too. And the idea of all this, so that's really not a lot of time. Come home from work, whatever, walking the dog, look at the news feed, do the chart like I said, start with the day and zoom out in time and really get a feel for what is going on with, the stock coming up, going down, whatever it might be. All the things that I mentioned, they're going to give you a real feel, a real vibe for the stock. And that's the babysitting part of it that, and frankly, the discipline that we talked about is doing this every single day. And honestly, while you're at it, until you get comfortable with it, go back and review the numbers that we talked about. Look at the price to earnings ratio. Look at the forward price to earnings ratio and compare those. Look at the price to sales, the revenue and net income. And from the net income and revenue, you get the profit margin. And then look at your free cash flow. Okay. That's not that much, but those numbers right there are absolutely going to be invaluable and give you such a great, and I promise you, just like everything else, this is going to become habit, muscle memory, and soon you'll just be able to like rattle off the numbers, and it's going to keep you in touch with what the stock is doing, and it is so important. And then we talked about the other stuff, the beta and the short sale percentage, and well, that's it. That's it for the analysis part of the four tenets of how to buy stock. So that's it for today's show too. So thank you for watching Wall Street Weatherman. I'll see you again soon. Cheers.